Hello, welcome back everyone again. The topic that I want to review today is how are mortgage interest rates determined? And I get this question a lot, and in fact, even more so than that, I get a question which is just simply, what's the rate today? Or what's the rate for a jumbo loan today, or something like that. And it's really impossible to answer that question without knowing a lot more about you and your situation. It's almost like going into a car dealer and saying, how much does a car cost? Because there's so many different kinds, and there are a lot of different options, and so many different things that would change that price. And the same thing on the mortgage side, so many different things that would change that rate depending on the situation. So what I'll do is I'll take you through some of the most common things that would impact the interest rate that your lender would offer you, okay? So the first thing is, and the primary and most important thing is your credit score. Credit score is the king when it comes to not only determining your interest rate, but also for many loan programs, your down payment amount too. So I've seen lender rate sheets where the swing between rates goes from 700 to 600 credit score, and it could be as much as a 3% difference in the interest rate just by going from a 600 to a 700 credit score, or vice versa. So the credit score is huge. Anything you can do to improve your credit score, and I'll have videos on how to improve your credit score as well. But anything you can do to improve your credit score will be huge in getting the best rate possible. The next thing is your down payment amount, or your loan to value ratio. So obviously for a loan like an FHA loan, for the most part, your down payment amount is fixed at 3.5%. But for many other loan programs, the more you put down, the lower your rate will be. So knowing that and having a larger down payment will definitely impact the interest rate that your lender can offer you. The loan amount, people don't realize this, but the loan amount is also going to impact your interest rate. The small loan amounts, lenders have rate add-ons for. And I'm not exactly positive as to where each lender comes up with their break. So for example, as you start to get below 200,000, 150, 100, below 100,000, the rate add-ons are going to be significant. And there is a cost to underwriting and processing and managing your loan before and after the close. So that's, I believe, partly why the interest rate would increase as you get down below $100,000, just as an example. The loan program will definitely matter. So if you have just a conventional Fannie approved mortgage, you're going to have potentially one type of interest rate, or one set of rates. A jumbo loan is likely going to be higher. FHA, VA, USDA, subprime loans, where you have someone that has a recent bankruptcy, non-QM or non-qualified loans, where it could be a bank statement loan for someone who's self-employed. So all these types of loan programs will definitely impact your interest rate. The other thing is property type. Is it a single family residence? Is it a multifamily building? I've seen 2, 3 to 4 unit property, sometimes just 3 and 4, depends on the lender. That will impact your rate. And of course, the big one is manufactured housing or mobile homes. There are some lenders that just won't touch mobile homes. If they do, they require a larger down payment, and definitely the interest rate is going to be different than if you were buying a traditional single family residence. So the residency is also going to impact your interest rate. Your primary residence, whether it's a second home or even an investment, will absolutely impact your interest rate. The documentation you can bring to the table. If it's full documentation where you have your tax returns, W-2s, all of that, that's one thing. But if you need a reduced documentation loan where you don't have tax returns, or you're self-employed and you can't qualify using them, that is going to impact your interest rate. Whether you're doing a refi, or especially a cash out refi, cash outs will have an interest rate adjustment with many lenders. So when you're seeing rates published and it differs from what you're hearing from your lender, some of that could definitely play a role in why the rate's different. If you have high DTI or high debt to income ratio, so most lenders or programs like to cap you at 43% as far as your DTI, and we'll do another video on DTI and some of these other things. But as you go higher into the 50s, 50% and higher DTI, you're going to see a rate adjustment. If you have a recent bankruptcy or foreclosure, any credit event, bankruptcy, foreclosure, short sale being the three major credit events, you will see a rate adjustment in a negative way. Some people like to pay their taxes and insurance on their own. They don't like to include it in their mortgage payment. Well, oddly enough, some lenders have a rate adjustment of up to potentially 1/8 of a point when you don't escrow your taxes and insurance. It's like they like to have that money in the account. They want to know that the taxes and insurance are getting paid, so there's no potential action taken by your township. So there's a little bit of a rate hit sometimes added to the rate that's offered to you by the lender if you're not planning to escrow your taxes and insurance. And then there could be a state adjustment. In some instances, some lenders believe that there's more risk in certain markets. I've seen rate adjustments for California, New York, Illinois, especially in the Chicago market. As we speak right now, this is the spring of 2020. There are things happening right now that you're going to remember as you see this video years later. And there were some lenders that were preferring not to lend in certain states until the environment changed and things calmed down. So a lot of concern for real estate values in certain markets right now. So those are other factors that impact your interest rates. So I hope this helps to describe, what the reason is for rates being offered by different lenders at different rates, and why your rate might be different than your brother or your sister's rate that was just offered to them yesterday, because their situation could be far different. So if you have any questions, you can put them in the comments below. I do have a full article that you could read about how interest rates are determined. You can click on the link down below and read the full article. And if you have any other questions, just let me know. Hopefully this was helpful to you. And if so, just please hit that subscribe and bell notification icon, and just check back for the next one. Thank you.